Hi, my name is Rahul Pal and I head the fixed income desk at Mahindra Mutual Fund. As the year draws to a close, we thank all our investors for reposing faith in Mahindra Mutual Fund and we look for an increased support throughout the next financial year. And we also thank all our distributors who helped us in this journey, and we also require your support throughout the next financial year and the years ahead. So I'll be talking about the debt markets during the month of March. A very interesting month for the debt markets in India. While the 10-year sovereign GSEC did not react much, the 5-year AAA corporate bonds moved down by 35 basis points, catching everyone by surprise. The trigger for such a sharp downward movement of corporate bonds was predominantly because RBI announced a 3-year $5 billion swap window. What it basically means is dollar liquidity flows into India at a hedged cost, and which may bring in some incremental corporate bond allocation from the FPIs. And that was the reason that corporate bonds in India rallied. And it rallied by close to 35 basis points. Globally too, we saw an extremely dovish Fed and a German 10-year sinking below, going into a negative interest rate territory, which was seen last year in somewhere in June of 2017. We've also seen global developed market yields also cracking below its lows, and it's actually come to a new lows. What happens next? We continue to believe the fact that interest rates should go down from here on. A part of it is because of a continued risk aversion which we see globally. Domestically, the Reserve Bank of India and the MPC meets on the 4th of April to give its decision. We think the MPC may announce a rate cut, and I would be surprised if they announce a stance change also. Unlikely, but if they do so, it's a trigger for the next big rally. We continue to believe in credits over GSEC at this moment, but credit spreads have shrunk very dramatically, and hence we may think the fact that the next trigger can be in good quality NBFCs where spreads might shrink. So now I'll be talking about our scheme specific strategies. I start with Mahindra Credit Risk Yojana. We continue to maintain a modified duration of around 1.9, which is relatively higher than the other peers. And we'll continue with this strategy as we think the fact that the credit spreads may shrink, and we are increasing our allocation to good quality NBFCs as we get incremental assets under management. For Mahindra Low Duration Bachat Yojana, we have moved the average maturity close to 280 days, which is on the higher side. This is on the expectation of a rate cut from Reserve Bank of India, and depending on the outcome of the Reserve Bank of India, we would position ourselves accordingly. But at this moment, we go in on the higher range of modified duration and average maturity. For Mahindra Dhan Sanchay Yojana, we continue to maintain a higher modified duration of close to 4.30, and for some time we intend to keep the same modified duration going ahead.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.